Good morning, everyone, and welcome. I call this meeting of the NCUA Board to order. I want to note for the record that due to the COVID-19 pandemic, today's meeting is open to the public through a live webcast only. The public may access the meeting by visiting the agency's homepage at www.ncua.gov and clicking on the provided webcast link. Additionally, participants in today's meeting are participating remotely. So if we experience any technical difficulties, I ask for everyone's patience. The first item on our agenda is the loan interest rate ceiling for federal credit unions. Staff presenting, John Nils, Senior Capital Market Specialist, Office of Examination and Insurance, and Justin Anderson, Senior Staff Attorney, Office of General Counsel. At the conclusion of their presentation, Vicki Narwald, Acting Associate Director, Office of Examination and Insurance, will join the group to answer questions. John and Justin, you may begin when you're ready.
Good morning, Chairman Harper, Vice Chairman Hauptman, and Board Member Hood. This is John Ellis, Senior Capital Market Specialist with the Office of Exam and Insurance. We are here today to request the Board's approval to extend the existing temporary maximum 18% interest rate ceiling on loans made by federal credit unions for the period from September 11, 2021 through March 10, 2023. This is an 18-month period, which is the maximum period allowed by the statute. Absent any board action before September 11, 2021, the loan rate ceiling will revert back to the statutory rate of 15%. If the loan rate ceiling reverts to 15%, the maximum permissible interest rate for payday alternative loans, or PALs, will also become 15%. Congress initially established a statutory 12% loan rate ceiling for federal credit unions in 1934. In March of 1980, through the Monetary Control Act, Congress raised the interest rate to 15% and authorized further increases at NCUA board discretion for periods not to exceed 18 months. Hence, the temporary nature of the NCUA board established maximum loan rate. Under the 1980 Monetary Control Act, if the board seeks to set a temporary higher maximum loan rate, more than 15%, it must determine that two criteria are met. One, a determination that money market interest rates have risen over the preceding 6 months, and two, a determination that not approving a higher interest rate would potentially threaten safety and soundness of individual credit unions, as evidenced by adverse trends in growth, liquidity, capital, and earnings. As outlined by our board action memorandum, we submit that the statutory criteria have been met to authorize a rate above 15%, and we recommend the loan rate ceiling be maintained at the current 18%. This level should provide sufficient room for federal credit unions to appropriately and competitively risk price certain unsecured loan products and allowed for a continuation of the payday alternative loan program. As the supporting analysis outlined in the BAM indicates, a significant number of federal credit unions, including many low-income designated credit unions, are making unsecured and payday alternative loans at rates above 15%. And these loans are an important source of affordable credit for many lower-income members. These loans are also an important segment of the portfolio for a significant number of our federally chartered institutions. While this recommendation would allow the temporary rate to stand for a new 18-month period, the board has the option to review and change, if necessary, the interest rate ceiling at any time before the period ends. Thus, you may choose to redeliberate the rate ceiling prior to the proposed expiration, which, as mentioned, is on March 10, 2023. For our part, staff continuously monitors trends in credit unions and the levels of market interest rates We will alert the board to changing conditions which may warrant a redeliberation of the maximum loan rate sooner than 18 months as warranted. This concludes my prepared remarks. We will be happy to answer any questions. Thank you.
Thank you, John and Justin, for your efforts to bring the temporary interest rate ceiling for federal credit unions before the NCUA board for consideration. Our actions today will provide certainty to federal credit unions that the current 18% maximum loan interest rate will continue until 2023. The Federal Credit Union Act requires that the NCUA board take action before September 11th, 2021 to change or reaffirm the current temporary maximum rate of 18%, 28% for payday alternative loans, or the maximum rate will revert to the lower of the statutory level of 15%, including for PALs. With today's action, the board will authorize a temporary 18% maximum loan interest rate for federal credit unions effective September 11, 2021 through March 10, 2023. Before reaching this decision, staff conducted an analysis of recent market and financial conditions. That analysis concludes that money market rates have risen over the preceding 6-month period. It also finds that lowering the interest rate ceiling below the current temporary 18% maximum would threaten the safety and soundness of individual credit unions due to the anticipated adverse effects upon liquidity, capital, earnings, and growth. Going forward, I encourage all credit unions to offer their members lower rates whenever possible and to develop loan products that will include a savings feature. Providing members with an easy-to-save way to save for a rainy day will help them weather small emergencies that might otherwise cause them to go to a payday lender. In fact, in my conversations with credit unions prior to and during the COVID-19 pandemic, I learned of several credit unions making short-term loans that include a savings feature or that carry an interest rate as low as 5%. During the initial days of the pandemic, some credit unions even offered these low-dollar loans with no interest rates for the first 90 days. These innovative and affordable products underscore the mission of the credit union system to provide financial services for everyone, including those of modest means. Thank you again, John and Justin, for your work on this matter. That concludes my remarks. I now recognize Vice Chairman Hauptman.
Thank you, Mr. Chairman. And I agree with you, by the way, that loans that have an automatic savings sidecar can be quite useful for a lot of people. There's actually legislation in Congress called that Sidecar Savings Act. So Congress raised the credit union interest rate cap from 12 to 15% back in 1980, a year when inflation was over 13%. And Congress also obviously gave NCUA discretion to raise that rate for a maximum of 18 months. Although the interest rate cap is somewhat unique to credit unions on the federal level, it isn't unheard of at the state level nor in other countries. People may debate if 18% is the correct rate or if we should have a variable rate. But as a practical matter, our rate cap isn't causing much concern. Plus the fact that we evaluate the policy every 18 months gives us a chance to review the policy. I will be supporting it and remain open to possible adjustments in the future. Thank you, Mr. Chairman. That concludes my remarks.
Thank you, Vice Chairman Hauptman. Board Member Hood, do you have any comments or questions?
Yes, thank you, Mr. Chairman. And John and Justin, I'd like to thank you for your presentation. I want to begin by making a few introductory remarks before I get to the matter at hand. And it's just that when we all sit and think back to where we were this time a year ago, it's just mind-boggling that when we think of in June of last year, the COVID pandemic was raging, with case numbers, hospitalizations, and deaths rising rapidly all over the world. Uncertainty and anxiety were rampant as medical professionals were still struggling to identify effective treatments. And it was believed that a vaccine was likely years away. Who would have thought that from those prognosticators then that I could sit before you all today fully vaccinated? But meanwhile, as we look back to the last year, the pandemic did in fact deal a crippling blow to our economy with sudden and massive increases in unemployment. I will remind you all that the jobless rate was well over 11% in June of last year, coupled with a drastic decline in GDP. Adding to the challenge, we were facing a serious moral reckoning in the weeks after the killing of George Floyd in Minneapolis, as people flooded the streets to demand change. In the most extreme cases, our cities face civil unrest and even violence. Of course, our nation has faced many challenges in our lifetimes, but few compared to what was unfolding before our very eyes at this same time last year. I often get a chance to speak to credit unions and conferences, and I've been doing that both during COVID and even today. And I spent a lot of time talking, ladies and gentlemen, about moving from risk to resilience as more and more Americans become vaccinated. It is a timely lesson because we're living it today. And when you look at some of the trend lines for credit unions we've seen in the last few weeks, we see proof positive of what that resilience means in the credit union world. For example, in the last quarter, federally insured credit unions reported net income growth of $11.3 billion, an increase of 134.9% over the year ending in the first quarter of 2021. Insured shares and deposits rose $286 billion, or 22.4%, to $1.56 trillion over the same time period. We've also seen steady loan growth and lower delinquency rates. These are strong performance numbers that I think we all can agree reflect a recovery in progress. There are many positive trends credit unions should indeed be proud of. And as credit unions and the overall economy recover, I would like to take this moment to call on our NCUA board to institute an advisory board. It's more important now than ever that we hear directly from credit unions. We need to do a much better job getting on the ground feedback directly from credit unions in a formal setting where credit unions do not feel they will be reprimanded for giving honest and constructive feedback. This issue also gets to the Vice Chairman's feedback loop survey following exams. And that's an initiative that I also fully support. I recognize that many of the federal financial regulators invited to the White House this week also have advisory boards. So I certainly hope we at NCUA can glean insight and create our own in the days ahead. But now, ladies and gentlemen, to the pending question before us. I will fully be supporting today's proposal. It's interesting to notice, I've said before, that today we're contemplating a renewal of the temporary maximum loan rate of 18%. A rate that has been sustained continuously by the NCUA board actions since 1987. And we do so now again at a time when lawmakers in various parts of the country are proposing laws to establish maximum loan rates on consumers at levels as high as 36%. So when you say that the 18% rate is allowing sufficient room for responsible pricing, we are still authorizing a ceiling far below what many contemporary policymakers view as a prudential rate cap. I'm indeed comfortable with the proposed rate, and again, will be supporting it. To my fellow board members, I hope we can eventually consider an advance notice of proposed rulemaking to seek stakeholder input on the concept of using a variable rate when setting these temporary rate ceilings. I know that this was an initiative that was delayed behind other board priorities in recent years and along with the COVID-19 fallout. But I must say that I am open to the idea of getting comments from federal credit unions on this topic. Now, Justin and John, I do have one question. Can one of you please speak to what can and cannot be done with the current statutory requirements of the interest rate cap?
I'm going to let Justin take that one. Board Member Hood.
Thank you, Board Member Hood. This is Staff Attorney Justin Anderson. What can be done under the current the current requirements of the statute is exactly what the board is doing today, and that is to consider increasing the interest rate ceiling above the statutory cap of 15%, provided certain key factors are met. And as John outlined, those are consultation with the other banking agencies and the houses of Congress, as well as determining that money market rates have risen over the preceding 6 months and that the prevailing rate or lowering the prevailing rate would threaten the safety and soundness of federal credit unions. That concludes my answer.
Great. Thank you, Justin. And I have no further questions or comments. Thank you all. Mr. Chairman, that concludes my remarks.
Thank you, Board Member Hood. And I really do appreciate your comments on the creation of an advisory board. Certainly, as we went through the confirmation process together, you heard me talking about that. One piece of my regulatory philosophy is that we need to be engaged appropriately with all stakeholders, and certainly finding the best ways to do that is something that we should continue to look at and continue to proceed to do. So I look forward to working with you in terms of community outreach, I'll call it. In addition to that, I also take very seriously your suggestion about having an advance notice of proposed rulemaking with respect to a floating interest rate cap. I know that there have been some staff concerns about it, but still, it's a question that we should work to explore, and we can certainly talk about more in the weeks ahead. Vice Chairman Hauptman, do you have a motion? I think you're on mute.
Yeah, you got it. For just a moment. Yes, indeed. I move that the board approve to maintain the current temporary 18% maximum loan interest rate for federal credit unions effective September 11, 2021 through March 10, 2023.
Is there a second to the motion?
I second.
I'm sorry. There is a sufficient second. All those in favor say aye. Aye.
Aye.
All those opposed say nay. The ayes have it, and let the record show that the motion passed 3-0. The second item on our agenda today is a final rule, Part 702, Current Expected Credit Loss Methodology. Staff presenting, Allison Clark, Chief Accountant, Office of Examination and Insurance, and Ariel Pereira, Senior Staff Attorney, Office of General Counsel. Following their presentation, Joy Lee, Associate Director, Office of Examination and Insurance, will also be available to answer any questions. Allison and Ariel, you may begin when you're ready.
Thank you, Mr. Chairman. Good morning. This is Allison Clark, and we are here to present the final rule addressing the adoption by credit unions of the current expected loss methodology, referred to by its common and well-known acronym, CECL. This final rule follows publication of an August 19th, 2020 proposed rule and takes into consideration the public comments received on the proposed rule. Federally insured credit unions will be required to commence implementation of CECL for fiscal years beginning after December 15th, 2022. Adoption of CECL will result in earlier recognition of credit losses. Upon adoption, an institution will record a cumulative effect adjustment to retained earnings known as the day one adjustment. This adjustment will be equal to the difference between the amount of credit loss allowance required under the current incurred loss methodology and the amount of expected loss allowance required under CECL. Many institutions could experience a sharp increase in expected credit losses as a result of the day one adjustment, which could lower their capital classification. The final rule here today mitigates these adverse effects to capital ratios resulting from that day one adjustment. For purposes of determining a federally insured credit union's net worth classification, the board will phase in the day one effects on the net worth ratio over a 3-year period. The NCUA will automatically apply the phase-in for eligible credit unions. These credit unions would not have the option of electing whether to opt into or out of the transition provisions. A federally insured credit union that determines adoption of CECL is in the best interest of that institution has the option to do so up to and until the effective date for CECL implementation. The final rule will also provide that federally insured credit unions with less than $10 million in assets are not required to determine their charges for loan losses in accordance with generally accepted accounting principles. These credit unions will instead be required to use any reasonable reserve methodology, provided that it adequately covers known and probable losses. I will now turn this presentation over to Ariel, who will discuss the public comments received on the proposed rule, and then I will further discuss the operation of the phase-in. Ariel?
Probably on.
Ariel, you may be on mute.
Okay, I believe he may have dropped off, so if we can just wait one moment for him to call back in.
Certainly, we understand technical difficulties do occur. And I do appreciate everybody's patience as we wait momentarily for Ariel to rejoin.
Hello, everyone. I'm sorry about that. I've gotten it back on the call.
That's perfectly fine. Go ahead, Ariel. The floor is yours.
Thank you, Chairman Harper. And good morning, Vice Chairman Hotman and Board Member Hood as well. This is Staff Attorney Ariel Pereira. The public comment period on the proposed rule closed on October 19, 2020. The NCUA received 18 public comments on the proposal. Comments were received from individual FICUs as well as from national, state, and regional organizations representing FICUs. Following consideration of the comments, 2 technical and clarifying changes have been made to the proposed rule. First, the final rule no longer references specific calendar dates in the discussion of the transition period for the phase-in. The regulatory text now consistently refers to fiscal years. This reflects the fact that some state-chartered credit unions operate under non-calendar fiscal years. The final rule also clarifies that state-chartered FICUs with less than $10 million in total assets and that are required by state law to comply with GAAP are eligible for the transition phase-in. The preamble to the final rule provides a detailed summary of the significant issues raised by the commenters and the NCUA's responses to the comments. I would like to briefly discuss the main issues that were raised by the commenters. 13 of the comments objected to the applicability of CECL to FICUs, largely due to the anticipated negative impact of the day one adjustment. The commenters wrote that FICUs building reserves to meet the CECL benchmark will be diverting funds that could otherwise be used to provide credit to members and communities. They urged the NCUA to continue exploring all avenues, including working with the Federal Accounting Standards Board to exempt credit unions from the CECL requirements. While believing that CECL should not apply to FICUs at all, the commenters unanimously supported the transition phase-in. Several commenters, however, suggested changes to the phase-in or possible alternative options for addressing the transition to CECL. 9 commenters, for example, urged the NCUA to provide a FICU with the ability to opt into or out of the transition provisions. In response, we note that the final rule does not compel any FICU to make use of the transition phase-in. As Allison noted, a FICU that determines adoption of CECL is in its best interest has the option to do so, and it's free to make this decision at any time until the effective date established by FASB for CECL implementation. We continue to believe, however, that requiring an affirmative opt-in from the majority of FICUs that require the phase-in would constitute an unnecessary administrative exercise. Further, automatic implementation of the phase-in by the NCUA will help to ensure its uniform application. Another suggestion made by multiple commenters was that the NCUA exercise its statutory discretion to redefine total assets in the computation of net worth and to establish alternative accounting standards to GAAP as possible means of addressing the CECL transition. We decline these suggestions as they would be complex and potentially time-consuming rulemakings with potential effects beyond the scope of facilitating the adoption of CECL. The final rule's preamble discusses the issues in greater detail, including the general requirement for NCUA's prompt corrective action regulation to be comparable to Section 1831O in the Federal Deposit Insurance Act regarding bank corrective action and capital requirements, including CECL. Again, readers should refer to the final rule's preamble for a more thorough discussion of these and the other comments received on the proposed rule. I will now return the presentation to Allison, who who will discuss the mechanics of the phase-in.
Thank you, Ariel. The final rule adds a new subpart G to the prompt corrective action regulations in 12 CFR Part 702, and it's captioned CECL transition provisions. The new subpart G applies to federally insured credit unions that meet the eligibility criteria specified in the final rule. Notwithstanding the CECL transition provisions, all other aspects of Part 702 would continue to apply. Under the phase-in, the NCUA would deem retained earnings and total assets as reported on the call report to be increased by 100% of the day one adjustment during the first 3 quarters following the adoption of CECL. Then, beginning with the 4th quarter of the fiscal year in which the credit union adopts CECL, the NCUA will deem retained earnings and total assets to be increased by 67% of the CECL transition amount. This percentage will then be decreased to 33% beginning with the 4th quarterly call report of the following fiscal year. Commencing with the 12th reporting quarter of the FICU's CECL implementation, the federally insured credit union's net worth ratio will completely reflect the day one effects of CECL. All other items remaining equal, this computation will result in a gradual phase-in of the CECL day one effects. The final rule issued by the other banking agencies rely on the banking organizations to calculate that phase-in amount. In contrast, the NCUA will make the required phase-in calculations. We believe that this will help ensure the uniform implementation of the phase-in, facilitate the accurate calculation of the transition amounts, and relieve credit unions of the administrative burden of having to make their own calculations. This concludes our prepared remarks, and we are happy to answer any questions that you may have.
Thank you, Allison and Ariel, for your efforts in preparing. What's that? Did you say something, Allison?
No, I just said back to you, sir.
Okay. So thank you so much again for your efforts in preparing and presenting this final rule before the NCUA board to phase in the day one capital adjustment under the Financial Accounting Standard Board's current expected credit loss methodology, otherwise known as CECL. And thank you, Joy, for joining us to answer any questions that the board may have. This subject is really a highly technical and complex one, and this final rule is a testament to staff expertise and effort. I will also say one of the things I really do like about this rule is that it is an elegant policy solution. It's something that we talked about quite a bit when I was in graduate school. And the elegant policy solution is the one that is simple to administer and apply, that accomplishes the goal without a lot of other work. And I know that there were, as Ariel pointed out, other ways that we could have potentially approached this issue, but this one does it cleanly and simply. When this rule was first proposed last July, I said earlier recognition of credit losses was a good thing. I still believe that. Indeed, as we have moved through the pandemic's economic fallout, many credit unions have increased their reserves in anticipation of coming losses. That transparency and management action is prudent. Nevertheless, implementing the CECL accounting standards should not prevent credit unions from serving their members and communities because they cannot manage their capital levels appropriately. That is why the rule before us is so important. Similar to a regulation already adopted by the federal banking agencies, this final rule is tailored to temporarily mitigate the initial impact of CECL's adoption by allowing a covered federally insured credit union to phase in the day one effects on its net worth ratio over a 3-year period under the NCUA's prompt corrective action standards. This phase-in will provide credit unions time to adjust to the change and grow capital organically without disrupting their ability to serve their members. Additionally, this change will provide credit unions with a measure of regulatory relief while still requiring them to account for the methodology for other purposes, such as in call reports they file with the NCUA. Also, under this final rule, and consistent with the Federal Credit Union Act, federally insured credit unions with less than $10 million in assets would no longer be required to determine their charges for loan losses under generally accepted accounting principles. Instead, these credit unions can use any reasonable reserve methodology if it adequately covers known and probable loan losses. The final rule also clarifies that federally insured state-chartered credit unions with less than $10 million in assets required by state law to comply with GAAP are eligible for the transition phase-in. As in the proposed rule, the phase-in in the final rule would only apply to those federally insured credit unions that adopt CECL for fiscal years beginning on or after December 15, 2022, the deadline established by FASB for CECL's implementation. Credit unions deciding to adopt CECL for fiscal years before that date would not be eligible for the phase-in. In sum, this final rule is a good first step in supporting credit unions as they make the transition to CECL. But we need to do more work. In particular, the NCUA must develop a simplified CECL spreadsheet for smaller credit unions. And we need to create training materials and issue more guidance to credit unions as we get closer to implementation. This work will facilitate the ability of all covered credit unions to comply with CECL accounting standards in the months ahead. On that point, I do have one question for you, Allison. What is the current expected timing for us to develop simplified CECL workbooks, create additional educational materials, and deliver training on CECL compliance?
Thank you, Mr. Chairman. I'm actually working with the E&I team on a project plan to roll out a simplified method. I'm targeting to have this ready by the end of the year. Additionally, we are developing educational material and training sessions for both credit unions and our examiners to begin next year. Back to you, Mr. Chairman.
Allison, that's really important. I'm glad to hear that. And we need to stay on target and on top of that. Credit unions are counting on us. One other thing that's sort of related to this is I often hear about credit unions, a $50 million credit union that's being approached by a vendor that's going to charge them $5,000 or even $25,000 a month. Would a simplified methodology that we're working on help credit unions to avoid such a cost? And would you advise a credit union to make that investment and in terms of that amount of money to comply with CECL?
Well, we would not expect any credit union to use a vendor-supplied model. The method that we are working on will certainly comply with the standard, the CECL standard. And if they do go with a vendor, then they could use this as an option for testing and validating the option that they purchased from a vendor. Back to you, Mr. Chairman.
That's a great suggestion, and thank you so much for that, Allison. Allison, Ariel, thank you again. That concludes my remarks. I now recognize Vice Chairman Huffman.
Thank you, Mr. Chairman, and thanks to Allison and Ariel for the presentation. First, I want to recognize Board Member Hood and former Board Member McWaters for their efforts in prior months to mitigate the significant burden that CECL places on credit unions. That burden isn't about the core concept of recognizing expected losses, but rather about things like data collection, the other details of being in compliance. I respect that NCUA employees, including the gentleman I just mentioned, have had discussions with the Financial Accounting Standards Board, FASB, to try to explain the credit union situation and try to make this work as well as possible for credit unions. So I just want to give a shout out to NCUA employees that have and are doing what they can with FASB to try to make this easier. I understand that Board Member Hood, along with former Board Member Waters, went to great lengths to urge FASB not to impose a one-size-fits-all rule. I believe Mr. McWaters, along with our Larry Fazio and Allison Clark, met personally with the then chair of FASB, Russ Golden, and the primary architect of CECL, Hal Schrader, to present potential options. I've also been made aware of continuing efforts, as I mentioned, by Allison Clark and others to limit the burden. So I want to thank Allison, Larry, and other staff for their ongoing efforts. They're definitely fighting a good fight there. This board doesn't have much power to make tweaks to CECL implementation, but I do agree with Chairman Harper that we should do everything we can to make life easier for credit union members. Today, we are just tasked with approving the phase-in process for credit unions. We should note the origin of CECL wasn't about credit unions, as it was born from the financial crisis, 2008-09, of which credit unions played very little part. So I empathize with credit unions that feel they're paying yet another cost for problems created by others. Credit unions are not only disproportionately smaller than other financial institutions, they're structured differently than institutions where CECL will protect shareholders. As cooperatives, credit unions don't have shareholders. There's no one demanding that management take risks to create a return on the investment. The member owners are, in effect, the shareholders. It's their money that is being spent to comply with this rule. I'm generally interested in seeing any info about if the benefits of CECL outweigh the cost for credit unions, particularly for smaller ones. The rule does have give NCUA the power to have some exemption for credit unions with assets under 10 million. But that's it. We should mention that CECL has major costs in time, effort, and regulatory risk. And a general rule for regulators and in life is anything with major costs should have major benefits. I'll note that I don't believe anyone at NCUA is saying that, for example, due to CECL, our share insurance fund has lower projected losses in the future. That said, I'll be supporting this rule today because it eases the burden of the day one adjustments. It spreads the accounting charge to regulatory capital over a 3-year period, giving credit unions time to replace capital if needed. And it allows the board to exercise its discretion to exempt credit unions under 10 million in assets from GAAP. In closing, I urge staff to continue their efforts to work with credit unions in complying with this mandate. Thank you, Mr. Chairman. That concludes my remarks, but I have a couple questions to our team here. So CECL has major costs. Therefore, it should have major benefits. What would you say for credit unions are the long-term major benefits of CECL?
This is Allison Clark. I'll take that one. The purpose of CECL is an improved recognition and a measurement of expected credit losses. CECL doesn't change the total amount of a loss a credit union will suffer. It just merely accelerates the timing of when it is recognized. When credit unions perform CECL, it will be a more realistic balance sheet, as it should represent the fair value of assets as well as the true health and strength of capital. And while credit unions don't have investors, it would be my belief that a more realistic balance sheet with risk presented appropriately will be a long-term benefit to the CIF. Additionally, we would see benefits with credit union management exercising improved credit risk measuring, monitoring, and control. And CEOs and loan officers may better understand risk associated with specific loan products and entire loan portfolios and price that risk accordingly. Back to you, Vice Chairman Hoffman.
Thank you. If you could wave a magic wand, what changes would you do to CECL implementation, et cetera?
What I would do is I would keep, if it were me and I had control and had a magic wand as you suggested, I would keep the incurred loss model as it is, and I would lift the language in the current GAAP standard that says probable losses and just expected losses, because as Chairman Harper noted, credit unions right now under the pandemic have been increasing their allowance using reasonable and qualitative and environmental factors as a way to adjust their allowance for losses they were expecting to happen that have not happened because they were under the incurred loss model. That's what I would do if I had a magic wand, Mr. Hoffman.
That is interesting. Glad we have somebody like you thinking about these things on staff. I'm not trying to knock another regulatory body. People certainly don't think what we do is always perfect or agree with it. So I understand that. Let me just say one final thing and humor me for a moment, if you will. So FASB has stated CECL will help investors and other users of financial statements. That's the phrase they use. However, when describing CECL's purpose over the last few years, the focus is clearly on investors. FASB's website right now says CECL will provide investors with better information about losses on a more timely basis. Allison, are there any investors and credit unions that will benefit from that?
There will be no investors that will benefit from that. Who will potentially benefit from that is us as an agency supervising these credit unions, as it may, again, have a long-term benefit to the CIF.
You got it. Thank you very much. And that concludes my remarks. Back to you, Mr. Chairman.
Thank you, Vice Chairman Hoffman, and as well as Allison for those insights. Board Member Hood, the floor is yours.
Great. Thank you, Mr. Chairman. And also thank you, Allison and Ariel, for your remarks today. And I just want to pick up with where the Vice Chairman mentioned. And yes, I did work diligently to meet with folks from FASB. I too met with Mr. Golan and others there from the organization. In fact, Allison was on the phone with me when we were talking, and I almost was pleading to exempt our credit unions from the rigors of CECL. And in fact, you all, when it comes to credit unions, I to this day continue to believe that CECL was a solution in search of a problem. It is not at all a rulemaking that is going to help our credit unions. And again, it was more designed for more Wall Street banks as opposed to Main Street lending institutions such as credit unions. But anyway, I've digressed. I'd like to now just begin by saying, first of all, according to a report recently issued by the U.S. Department of the Treasury, numerous market factors relating to the COVID-19 global pandemic have affected the economy, financial institutions, and borrowing and lending dynamics. And while the Treasury's report noted the difficulty in establishing a definitive linkage between such trends and the introduction of CECL due to the effects of the pandemic, it recommended that FASB expand its efforts to consult and coordinate with the prudential regulators to understand and take into account, when considering any potential amendments to CECL, the standard's regulatory effects on financial institutions. Treasury also recommended that FASB further study CECL's anticipated benefits and, together with the prudential regulators, examine its application to smaller lenders. I echo these sentiments. Indeed, for credit unions in particular, the compliance costs associated with implementing CECL overwhelmingly exceed its benefits, especially for smaller credit unions with limited resources, expertise, and available systems to help them implement the standard. At a time when credit unions should now be focusing their attention on serving their member owners and focusing on the world post-COVID-19, the absolute last thing they need is to be burdened by a costly methodology that could have a deleterious and chilling effect on lending, especially in underserved, minority, and rural communities that are most vulnerable to the pandemic and its effects. Today's rule is a gradual phased-in approach and would apply only to federally insured credit unions that adopt CECL for the fiscal years beginning on or after December 15, 2022, the deadline for CECL's implementation. Credit unions deciding to adopt the standard for the fiscal years before that date would be ineligible for the phase-in. If credit unions do not want to phase in CECL, they should adopt the policy by December 31st, 2022. The proposal would also exempt credit unions with less than $10 million in assets from the following generally accepted accounting principles for loan loss reserves. Instead, these institutions could use only reasonable reserve methodology if it adequately covers known and probable loan losses. As of the last call report, this impacts roughly 1,105 credit unions. This final rule gives credit unions more time to prepare for the impact of CECL on their net worth levels. It will also give credit unions more flexibility to serve their member owners during this time of need. But these measures can limit some of CECL's effects and costs. The only way to fully ameliorate the consequences of this methodology on credit unions is a complete exemption. And as Allison can attest from our meeting, I respect FASB's independence and the important role it plays in setting financial accounting and reporting standards. I also appreciate their openness to my concerns and those of the credit union community. But the industry needs a permanent exemption from CECL, and FASB should grant it as soon as possible. The imposition of the new CECL standard creates an unnecessary burden that, again, that would diminish the ability of our nation's credit unions to serve their members and communities. I now have just one question. Have we modeled how CECL will impact credit unions' net worth? I realize this was highlighted in the recent Treasury report, but now that COVID-19 is somewhat subsiding and we're seeing a little bit of change in market activity, has anything changed from that report?
Board Member Hood, this is Allison Clark. I'll take that. I have been modeling the impact of CECL since probably 2018 on what would happen with the capital decreases. As of March 31st of this year, of our 5,068 credit unions, in a base case scenario, there were 79 credit unions that are undercapitalized and below. Again, that's a little bit inflated simply because of the increase in assets due to pandemic funding. And as I've stated, the allowances are higher today in anticipation of losses that have not yet been experienced. If I take the current allowances as of March 31st and I shock that 30% and then take that 30% change to as their day one adjustment to capital, the number of credit unions that would fall to undercapitalized and below is 109. So that is just a mere change of 30 credit unions from the base case to a 30% shock. Back to you, Board Member Hood.
Great. Well, thank you for that response, Alice. And I also want to thank you from your response to the chairman's question regarding training and a notebook and all the other tools that are going to be necessary to help our credit unions comply with CECL. So delighted to know that you are putting together some training materials that would assist. Also, I'd just like to note that given some of the work that we at NCUA are doing around innovation and fintech, I was recently made aware of a fintech provider out in Silicon Valley that is looking at a software tool that can be used on a credit union's iPhone or Android. I don't want to particularly pick out any type of technology there, but the point is there are folks that are looking at fintech solutions that can be used to help guide some of this when they're calculating their loan loss reserve levels. And I think I'm hoping that that will be a little bit more cost effective than the thousands of dollars that you mentioned earlier that many credit unions would have to spend if they were to go with a vendor. And again, it just troubles me that the burden this will have on smaller institutions, the increased costs, but again, I am at least glad to know that we're going to be giving them some training. So I have no further questions or comments.
Thank you so much, Board Member Hood, and I do appreciate your concerns about the costs of implementation, which is exactly why it is so important that we have us in developing simplified CECL spreadsheet, because it will make life easier for credit unions, particularly small credit unions. Larger credit unions have different needs, different expectations, how their loan portfolio is going to perform, not to mention oftentimes more complex risks that need to be considered and accounted for. But for smaller credit unions with a basic balance sheet, to the extent that we can help them with a simple tool, we certainly should do that. And certainly, another benefit that we have with respect to the CECL standard is it's not only going to potentially protect the share insurance fund, but certainly the secondary capital, the subordinated debt investors might get insights from this, as well as uninsured depositors might be able to draw some information from it. That really concludes all of our discussion on this item. Board Member Hood, do you have a motion?
Yes, Mr. Chairman. I move that the board approve final rule part 702 of the NCUA's rules and regulations as attached to the board action memorandum.
Is there a second to the motion?
I second the motion.
There is a sufficient second. All those in favor say aye.
Aye.
Aye. All those opposed say nay. The ayes have it, and let the record show that the motion passed 3-0. The third and final item on our agenda today is Final Rule, Part 741, Appendix B, Capitalization of Interest. Staff presenting, Myra Tepe, Director, Office of Examination and Insurance. Joe Goldberg, Director, Division of Consumer Compliance, Policy and Outreach, Office of Consumer Financial Protection, and Gira Bose, Senior Staff Attorney, Office of General Counsel. At the conclusion of their presentation, Allison Clark, Chief Accountant, Office of Examination and Insurance, will join the group to answer any questions. Myra, Joe, and Gira, you may begin when you're ready.
All right. This is Myra Tepe, Director of the Office of Examination and Insurance. Good morning, Chairman Harper, Vice Chairman Hopman, and Board Member Hood. We are here today to present a final rule amending Part 741, Appendix B. This appendix sets forth requirements regarding loan workout arrangements. More specifically, this final rule changes Appendix B, permitting the capitalization of interest when federally insured credit unions are working with their borrowers to modify the terms of an existing loan. The appendix presently reads as follows. The loan modification policy must establish sound controls to ensure loan workout actions are appropriately structured. The policy must provide that in no event may the credit union authorize additional advances to finance unpaid interest and credit union fees. This final rule removes the prohibition on additional advances to finance unpaid interest. As was discussed when the rule was proposed, and to provide some background, throughout the year, the NCUA and the other banking agencies have been encouraging financial institutions to work with borrowers impacted by the COVID-19 pandemic. The CARES Act provided forbearance for many borrowers that may have resulted in an unprecedented amount of accrued interest for many of these loans, as payments may have been delayed. This rule change provides credit unions a much-needed option to help borrowers by allowing the capitalization of interest as a loan modification tool. During our research, we noted that the banking agencies do not have a corresponding rule that prohibits the capitalization of interest. As a result, our current rule puts credit unions at a competitive disadvantage with banks. This final rule remedies that issue. In the proposed rule, we asked several questions for which we requested responses and also addressed certain consumer financial protection issues. I will turn the presentation over to Gira Bose of our Office of General Counsel to discuss the summary of comments received on the rule.
Thank you, Myra. Thank you. Thanks, Myra. Good morning, Chairman Harper, Vice Chairman Hopman, and Board Member Hood. This is Gira Bose, Senior Staff Attorney with the Office of General Counsel. The proposed rule provided for a 60-day public comment period, which closed on February 2nd. We received 26 comments in response to the proposed rule. These came from federally insured credit unions, individuals, and credit union leagues and trade associations. In general, the commenters expressed support for lifting the prohibition on interest capitalization, as it would be a helpful tool to assist financially distressed borrowers. The main reasons given by commenters for supporting the proposed rule were parity with banks, which, as has been already mentioned, are not prohibited from capitalizing interest, parity for credit union members whose loans are held in portfolio by the originating credit union and who, unlike members whose loans are sold on the secondary market, cannot currently take advantage of interest capitalization because of the current rule that we have in place, and flexibility for distressed borrowers for whom interest capitalization may be the only realistic solution for avoiding foreclosure. While noting the board's interest in receiving public comment on all aspects of the interest capitalization issue, the preamble to the proposed rule asked 6 questions requesting input on specific issues related to the proposed rule. Specifically, commenters were asked to explain their experience or level of use with interest capitalization before NCUA prohibited the practice in 2012, how likely credit unions would be to use interest capitalization if the prohibition were lifted, what risks might arise to either the credit union or member in a mortgage modification that includes interest capitalization, and how the limitations imposed by the government-sponsored enterprises Fannie Mae and Freddie Mac would impact the credit union's use of interest capitalization. Commenters that answered these questions generally reported that interest capitalization was used prior to 2012 and would be used again as warranted by an individual member's situation. The GSE policies would not pose a problem, and that any risks that might arise from permitting interest capitalization would be mitigated through clear communication with credit union members and by virtue of the consumer protection guardrails required by this rulemaking. Commenters were asked to provide feedback on the consumer protection guardrails, which Joe Goldberg will go into shortly. A large majority of the commenters expressed support for the guardrails, and the final rule adopts them without change. Finally, the proposed rule asked for feedback on the current prohibition on capitalization of credit union fees and commissions. Commenters were almost evenly split on whether or not to lift the prohibition on credit union fees. Those in support of removing the prohibition stated that credit unions should have the ability to capitalize fees so long as those fees were disclosed and reasonable. Those in support of maintaining the prohibition noted that they did not deem it necessary to charge such fees or feel that it was appropriate to charge internal fees to members who are struggling. Upon considering the comments, the final rule maintains the prohibition on credit union fees and commissions. The preamble to the final rule addresses in more detail the comments received in response to the questions posed in the proposed rule and other issues raised by the commenters. After careful review of the comments, the proposed regulatory amendments are being finalized without change. However, the preamble to the final rule does clarify the agency's supervisory position with regard to federally insured credit unions that may already have begun offering interest capitalization prior to the finalization of this rule. As explained more fully in the preamble to the final rule, NCUA is cognizant of the extraordinary nature of the COVID-19 pandemic and the resulting stresses that have been placed on credit unions and their members. Therefore, NCUA will take into account the previously issued pandemic-related interagency examiner guidance in assessing any loan modification actions taken by credit unions, including interest capitalization, prior to the effective date of this final rule. I will now turn the presentation over to Joe Goldberg to discuss in more detail the consumer protection guardrails included in the final rule. Over to you, Joe.
Thank you, Gara. Good morning, Chairman Harper, Vice Chairman Hauptman, and Board Member Hood. I am Joe Goldberg, Director of the Division of Consumer Compliance Policy and Outreach in the Office of Consumer Financial Protection. As Myra mentioned, the final rule contains language designed to ensure loan modifications and accommodations that include capitalized unpaid interest provide consumers with appropriate protections. Because residential mortgage loans in particular present heightened concerns, the final rule's guardrails aim to ensure successful outcomes for those when possible. Lessons learned from the last economic crisis show that capitalizing unpaid interest, when implemented prudently, can save loans. Capitalizing unpaid interest is often a feature in the programs created to help the residential mortgage market. As noted in the NCUA's 2009 Supervisory Letter, LCU 2009-19, entitled Evaluating Residential Real Estate Mortgage Loan Modification Programs, studies by the OCC, OTS, and FDIC indicate that the term that gave modified loans the best chance of success was lower monthly payments. So loans with capitalized unpaid interest, along with other appropriate terms, performed, which benefited both borrowers and lenders. I'd like to highlight some of the specific consumer protections in the final rule. First is the rule requires credit unions to adopt policies and procedures with the ultimate goal of modifications leading to a favorable outcome for borrowers. Credit unions must consider specific protections when capitalizing unpaid interest. The most important is to determine that the borrower has the ability to repay the debt. The rule does not prescribe a specific method for making that determination, which provides flexibility. However, the credit union will have to maintain documentation reflecting how it made that determination, including evidence of the borrower's source of income. Second, credit unions must comply with all applicable consumer protection laws and regulations. Among these are the Truth in Lending Act and Regulation Z, its implementing regulation, RESPA, which is the Real Estate Settlement Procedures Act, and Regulation X, and the Equal Credit Opportunity Act and Regulation B. RESPA regulates many aspects of the loan modification process and contains significant protections and disclosure requirements. The Equal Credit Opportunity Act ensures all borrowers are treated fairly and equally. And credit unions must also comply with the Dodd-Frank Act's prohibitions against the use of unfair, deceptive, or abusive acts or practices. Third, all documentation, including required disclosures, must be accurate, clear and conspicuous, and consistent with applicable federal and state laws and regulations. Fourth, credit reporting must also be accurate and in compliance with the requirements of the Fair Credit Reporting Act, and when applicable, the CARES Act and state law. Fifth, under the policies and procedures, a credit union should consider options to permit borrowers to make missed payments at the end of their modifications to avoid delinquencies or other adverse consequences. That flexibility can help lead to favorable outcomes for consumers and reduce credit union losses. Finally, the final rule states that detrimental terms, such as those resulting in negative amortization, will not lead to favorable outcomes and should not be included in these modifications. I would also like to address one other provision of the regulation that will remain the same. That is the heightened scrutiny by NCUA examiners when a credit union modifies a loan more frequently than once a year or twice in 5 years. While frequent modifications could result in loan churning detrimental to borrowers, especially for loans secured by a consumer's residence, the lessons from the last crisis teach us that when bad economic conditions persist over a long period of time, some borrowers can benefit from several modifications. When complying with the standards of the final rule, it can be appropriate for a credit union to make more than one modification to ensure borrower success. Now, that should not be interpreted as a license to repeatedly modify, but it provides credit unions another way under proper circumstances to help their members. And this concludes our presentation. Myra, Gira, Allison, and I are available for questions.
Thank you, Joe, and thank you as well to Myra and Gira for your efforts to finalize the capitalization of interest rule, which the NCUA board is considering today. I would also like to thank Ariel, Allison, Matt, Martha, and the many others on the NCUA staff for their work on this matter. This rulemaking really has been a team project. Through hard work and cross-agency collaboration, we have developed a well-crafted final rule that protects members and provides credit unions with needed flexibility. This rule is another targeted measure by the NCUA board aimed at helping credit unions and their members navigate the COVID-19 pandemic's economic environment. This final rule will also give credit unions parity with banks, Fannie Mae, Freddie Mac, and the Federal Housing Administration, all of which already allow servicers to capitalize interest as part of a prudent modification program. The clouds of the pandemic do appear to be lifting at this time, and we are starting to see the green shoots of an economic recovery take root. Credit unions have generally weathered the pandemic fairly well and reported strong net income, steady loan growth, and lower delinquency rates in the first quarter of this year. But I must caution everyone that we are not entirely out of the woods of the pandemic's financial and economic disruptions just yet. For more than a year, several government stimulus programs and interventions have saved our economy from a more severe contraction. But many of these initiatives are starting to end. Only when these programs expire will we know the pandemic's actual effects on consumers' personal finances and credit union balance sheets. One thing that we do know is that expiring unemployment benefits, mortgage forbearance programs, and eviction moratoriums, along with slow job growth, will cause many households to experience financial stress in the months ahead. This is especially true for low-income individuals and communities of color, which were disproportionately affected by the pandemic and the resulting recession. A personal finance storm could lie ahead for many, and credit unions need to have appropriate tools to support their members. For borrowers experiencing financial hardship, a prudently underwritten and appropriately managed loan modification consistent with consumer financial protection laws and safe and sound lending practices is generally in the long-term best interest of both the borrower and a credit union. Such modifications may allow borrowers to remain in their homes and help to minimize the costs of default and foreclosure for both the credit union and its member. That is what makes this final rule on capitalization of interest such an important issue. Specifically, the final rule would remove the prohibition on credit unions from capitalizing interest on loan modifications while maintaining the important prohibition on a credit union capitalizing fees and commissions. It also establishes ability to repay requirements to ensure that the addition of unpaid interest to the principal balance of a mortgage loan will not hinder a borrower's ability to make payments or become current on the loan. These measures would apply to workouts of all types of member loans, including commercial and business loans. As I noted when this rule was first proposed, the NCUA board expects that federally insured credit unions provide capitalization of interest as only one of several components in any loan modification, such as extending the term of the loan or lowering the interest rate, which are designed to help borrowers resume affordable and sustainable payments. In other words, capitalization of interest is one potential ingredient in the recipe to modify a loan. Additionally, it is important to underscore that the best interest of the borrower provision in this rule prohibits predatory lending practices, such as negative amortization. And in those cases where state law applies and is more stringent, credit unions must comply with those consumer financial protection standards. So this rulemaking really establishes a regulatory floor, not a ceiling for consumer financial protection. Finally, the NCUA has instructed its examiners to refrain from criticizing a credit union's efforts to provide prudent relief for members when conducted in a reasonable manner with proper controls and management oversight. As such, credit unions should continue to focus on the needs of their members and the communities they serve by providing prudent relief measures like capitalization of interest as part of a loan modification package. In the long term, members will remember who supported them during their times of need, and credit unions will be fulfilling the cooperative philosophy at the heart of the credit union movement. Before recognizing the other board members, I do have a few questions which I will ask together. What are the plans for issuing new letters to credit unions about this change in our rules? How quickly will we get those letters out? And how quickly can credit unions start using this new tool?
Thank you, Chairman Harper. This is Myra Tepe. We are going to be issuing an update to some previous letters to credit unions soon as possible. This rule goes into effect 30 days after it's published in the Federal Register. But as you heard Gira discuss, there is some language in the preamble, and I will read it again just to emphasize, that talks about the interagency guidance specifying that examiners will not criticize institutions for working with borrowers as part of the risk mitigation strategy intended to improve existing loans, even if the restructured loans have or develop weaknesses that ultimately result in an adverse credit classification. The NCUA will take into account interagency examiner guidance in assessing any loan modifications taken by credit unions, including interest capitalization, prior to the effective date of this final rule. So we are going to incorporate this preamble into the guidance that we issue to staff. So that concludes my response. But I wanted to assure you, Chairman Harper, that we are going to include that. We included it in the preamble language, notices to staff, and in letters to credit unions. That concludes my response, sir.
Myra, thank you so much for that. I really do think it is important that we get credit unions to use this and understand that it's out there. I know that it takes a little bit of time for us to generate letters to credit unions, but the sooner the credit unions start using this, the potentially better it is for members, particularly those who may be experiencing stress. As we learned during the Great Recession more than a decade ago, avoiding foreclosure to the greatest extent possible is often a win-win-win for consumers, credit unions, their communities, and our country. This final rule would serve members and our economy well in the long run. That concludes my remarks, and I now recognize Vice Chairman Hauptman.
Thank you, Mr. Chairman. And thanks to everyone who's involved in this, including Myra, Gira, Joe, Allison, and I'm still likely missing a couple people. This amendment was proposed for comment just prior to my arrival on the board, but I appreciate the collaboration that occurred across NCUA, as well as the comments submitted by stakeholders. Part 741 Appendix B sets forth requirements regarding loan workout arrangements. Specifically, the appendix currently states that the credit union must have a loan modification policy with controls to ensure the loan workout actions are appropriately structured. As mentioned earlier, the policy must provide that in no event may a credit union authorize additional advances to finance unpaid interest and credit union fees. I was surprised to learn that credit unions are the only financial institutions that have this prohibition. I joined the NCUA board this past December, and at every board meeting since, we've encouraged credit unions to work with members impacted by the pandemic, just as NCUA has done since the pandemic began. I should note that credit unions don't need us to tell them how to support their members. They were going to do it anyway, but we can give them the flexibility to do it more effectively. And I commend everyone at NCUA for putting things like this in the affirmative, given how useful that can be for a credit union's compliance officer. At its essence, this proposal is about supporting one of the key things that credit unions do, working with their members in times of difficulty. We should also note that sometimes we hear, right or wrong, that the board's actions don't always perfectly translate to the credit union during exams. Just want to mention that is would be a good use of the feedback mechanism that we're all working on. You could just flat out ask about this amendment. And also, if for some reason you feel that our actions are not being translated correctly, you can always contact my office, and I think the other board members directly to mention that. I'll say that this amendment gives credit unions parity with banks, but it's also our acknowledgement of the importance of the difference between cooperatives and other kinds of lenders. And while the CARES Act provided welcome mortgage forbearance for borrowers who need it, it's also resulted in an unprecedented amount of accrued interest for many loans. As the economy heals and forbearance is no longer needed, many member owners may be unable to meet the original loan terms. This rule will provide credit unions a mutually beneficial option to help member owners stay in their homes. When a credit union has more tools to work with troubled debt, they help that borrower, but also protect the interests of other members. As staff mentioned earlier, studies have indicated that loan modification with the best chance of success is lower monthly payments. It's our expectation that the capitalization of interest is just one of several options as credit unions help distressed borrowers resume affordable and continued payments. Mr. Chairman, that concludes my remarks, but I do have a couple questions. First one would be, we touched on this earlier, we want to avoid loan churning as a result of frequent modifications. Some borrowers may need more than one modification. Can you guys review how this rule addresses this?
This is Joe Goldberg, Vice Chairman Hopman. I'll take that question. The final rule does have the language in it that modifications of more than once in a year, and I believe it's twice in 5 years, would result in heightened scrutiny by NCUA examiners because the frequency of loan modifications could be considered to be churning. That's not beneficial to consumers. But that's not a restriction. It is just an awareness of that. So the language, and that's actually in the existing the rule. We did not change that. That language allows credit unions the flexibility to make a complete evaluation of the circumstances of the borrower to determine whether or not an additional modification will help. Oftentimes with modifications, the first go-round does not result in a good outcome. A borrower may still be having financial difficulty, and the lender can engage with the borrower and make an additional modification or second, sometimes third modification until either the proper terms are reached or the borrower regains financial footing and is able to make the payments of whatever the modification may be. So the rule has that flexibility, but it also gives the agency the ability to make sure that a credit union is not engaged in churning by making unwarranted additional modifications. And that concludes my answer.
Thank you, sir. Excellent answer, and I'm glad to hear all of that. I think it was somewhat useful to review that. I just have one more. If you remember when the CARES Act was first passed with the mortgage forbearance, there was concern from some that they'd have to pay it all back at once when the forbearance ended. Can you just walk us through the options? Let's say somebody has skipped 6 payments of $1,000 each, right? So there's $6,000 of payments that they did not make, and now they want to end the forbearance. What are the options what does that borrower have? What are the options they have at that point?
Sure, it's Joe Goldberg again, Vice Chairman. I'll also take this question. Well, first, there's no legal requirement that a lender provide any specific accommodation. And unfortunately, in some circumstances, it may be that no modification is appropriate, that the borrower is just not in a position to be able to save the loan. But the circumstances depend on each borrower's ability to repay, employment, and some other factors. So if a person, let's say, is now reemployed and has supportable income, then the credit union should make a determination of what kind of repayment plan is appropriate. So some borrowers might have the means and the desire to make a lump sum payment to bring the loan current and then return to making their regular payments. That would certainly be an option. Otherwise, the unpaid interest could be capitalized. You could have an extension of the maturity so that the term is longer. There could be some type of loan forgiveness. There could be interest-only payments for a period of time until the borrower regains financial footing. And there are a number of other options. So each modification should be specific to what works for the individual member. And that concludes my response.
Gotcha. Okay. Thank you. So that person that skipped 6 months, didn't pay $6,000 worth of payments, they can either write a check for the $6,000 and go back to how things were. You mentioned possibly interest only, possibly some loan forgiveness, and then restructure it into a lower payment. Does that pretty much run the gamut of what somebody out there could do?
There's probably some other options. You could enter into have a second mortgage transaction to account for the unpaid amounts during that period of forbearance. There could be a balloon payment at the end of the mortgage term, or whatever the loan term, whatever it may be. There's probably a few others I can't think of offhand, but there are a number of options that institutions who are interested in saving the loans, as the chairman said, lenders have an interest in saving these loans the same as the borrower does. So there are a number of ways that they can get creative to make sure that the loan gets saved. And that concludes my response.
Right. As you know, we had a refinancing boom in this country, in the last year and change. I refinanced my mortgage as well. Somebody in forbearance, though, probably wasn't going to do a refi while they weren't current on their loan. So if they miss the refi boom and rates are in a good place, could the restructuring, capitalization of the interest also serve as a form of refinancing that's attractive, that would be attractive anyway because they're in a better rate environment? Or that they just have less to pay on their mortgage, so a refi regardless would lower their... I mean, is this kind of a quasi refi if somebody wanted to?
This is Joe Goldberg, Vice Chairman. Yes, in essence, it could be. It may not be a formal refinance where the initial transaction is paid off in a new one, but it has the same effect if you do have terms, say, lower interest payments, re-amortize over a full, maybe 30-year term, which could also reduce payments on the existing balance. So it is equivalent to that. Yes. Thank you.
Yeah, gotcha. I think we're just doing a public service announcement that if you miss the refi boom and you're in forbearance, as you come out of forbearance, you can sort of get the benefit of refinancing if it is indeed attractive to both the lender and the borrower. Mr. Chairman, that concludes all my comments. Back to you.
Thank you so much. And by the way, when you started, you talked about the role that board members play as an ombudsman. Certainly, amongst our many duties, that is something I have found, that we learn of problems and we help people to cut through red tape and get through issues. Board Member Hood, do you have anything you want to add or ask?
Yes, thank you, Mr. Chairman. Let me begin by thanking Myra, Joe, and Gira, and I know Allison, you worked on this rule as well. So thank you all. And I want to applaud credit unions for the work that they continue to do amid the pandemic to help their member owners refinance and do all the tasks that's necessary to keep them in their homes, keep them with their cars, and all of the products they come to rely on each and every day. Keeping regulation effective but not excessive has been a top priority of mine and a theme during my tenure on the NCUA board, both when I was here over a decade ago and as I'm here today. And you all, that's why I've spent a fair amount of time ferreting out the areas where the agency could prudently relieve burdensome regulations where appropriate without losing sight of our safety and soundness mission. At the onset of the COVID-19 pandemic, that priority shifted really into high gear. So I just have one question. As we now move to a world post-COVID-19, how can credit unions benefit from this final rule? Or said it simply another way, could someone please state for the record why this rule matters to credit unions now, especially, again, it seems that we are somewhat turning a corner or maybe even recovering somewhat from COVID-19?
This is Myra Tepe. I'll take that question. Basically, this rule is not just for the COVID pandemic. This rule is for going forward, even after the pandemic. This just gives credit unions another tool in their toolbox in order to work with borrowers. So I think it is really important. It puts credit unions on par with banks, and it is, again, another tool for them to use to help their members modify loans. So that concludes my response, sir.
Great, thank you, Myra. And from doing our briefing, you know, I really was excited about this one, putting us in parity with our peer banking regulators, and also the fact that it really is going to extend beyond the pandemic. So I'm glad that we were able to get that point out for the record. The final rule amends the requirement in the May 2012 final rule that relates to the capitalization of interest. And as I mentioned earlier, the credit union industry has a long history of assisting its member owners, especially in times of need. While I wish we had this tool in the toolbox for credit unions earlier in the pandemic, it is better to have this rule done now rather than have nothing at all. And while I do not have any further questions on the pending question before us today, and will be fully supporting this final rule, I would just say in closing, Mr. Chairman, I would like to say I look forward to working with you and my board colleagues to bring a final QSO rule forward as soon as possible. And based on previous conversations with the board offices, I appreciate the board's commitment to do just that. So thank you.
Great, and thank you, Board Member Hood. And you know, to go back and supplement Myra's answer to your question, I think, you know, this rule right now is important because as those moratorium periods and as those forbearance programs and credit unions are going to have this, and that's going to help with at least an initial flow. But I also think it's really important, as Myra made the point, that they're going to have this going forward. So that really concludes our discussion on this particular board item, agenda item. Vice Chairman Haltman, do you have a motion?
Yes, sir. I move that the board approve final rule, part 741, appendix B of NCUA's rules and regulations as attached to the board action memorandum.
Is there a second to the motion?
I second.
There is a sufficient second. All those in favor say aye.
Aye.
Aye. All those opposed say nay. The ayes have it, and let the record show that the motion passed 3-0. That is the end of our agenda today, and there being no further business, we are hereby adjourned.